Bitcoin is facing a $450 billion supply shock. And Wall Street, well, they just didn't see it coming. That massive number, that's the value of long-term Bitcoin being locked away by serious holders. In the next few minutes, you're going to understand the mechanical reason Bitcoin's price is climbing even without all the retail hype, and why these new ETFs have changed the game forever. So you've probably felt it, right? Why does the market feel so different this time? It's the big question on everyone's mind. The rallies feel stronger, the dips get bought up in a flash. We're going to break down exactly why. Okay, let's get into it. To really get where we are now, we have to first understand where we've been. For over a decade, Bitcoin's price followed a very familiar, almost predictable script. It was a market pretty much run by emotion. You remember those cycles, right? You had the crazy retail hype, these massive speculative blow-offs, and then, like clockwork, the emotional panic selling. Yeah, that kind of volatility created fortunes, but it also caused these epic crashes. Well, listen, that era is over. It's been replaced by a whole new structural reality. And the catalyst for this huge shift? It's Wall Street's new machine, the spot Bitcoin ETFs. Look, their arrival wasn't just another headline. It fundamentally rewired the market's plumbing. Now, what's so critical to understand here is that these aren't just paper contracts. No, spot ETFs have to buy and hold actual Bitcoin. That means for every single dollar that flows in, real Bitcoin gets scooped up and taken off the market. And here's the kicker. Unlike a retail trader who might panic sell, these institutions are in it for the long haul. It creates a one-way street for supply. And this right here brings us to the heart of this whole thing, the great supply squeeze. And honestly, it all boils down to some super simple math that, frankly, it feels like most of the market is completely missing. Okay, lean in. This is the part nobody is properly explaining. Let's forget all the narratives, all the stories for a second. This is just mechanics. It's a simple, powerful, and absolutely relentless imbalance. All right, let's break it down. Every single day, the Bitcoin network creates about 900 new coins. That's it. That is the entire new supply for the day. Now, look at the other side of the equation. The new demand from these ETFs has been consistently eating up 5, sometimes even 10 times that amount. And not just once in a while. We're talking day after day after day. And this chart just shows you the insane scale of this mismatch. I mean, just look at it. You see that tiny bar of new supply? Now look at that massive, unwavering bar of institutional demand. When demand outstrips new supply by this much every single day, well, something's got to give. And this whole epic imbalance is playing out against the backdrop of something we all know, but maybe forget the power of: absolute, unchangeable scarcity. There will only ever be 21 million Bitcoin. You can't negotiate with that number. You can't print more. It is fixed forever. So all of this leads to a really powerful and, yeah, kind of counterintuitive idea. In this new world, Bitcoin doesn't actually need a flood of new retail buyers to push the price higher anymore. It just needs sellers to disappear. Let that sink in for a second. If the ETFs have to buy way more Bitcoin every day than is being created, where do they get it? They have to get it from existing holders, so the price just has to rise mechanically to whatever level it takes to convince someone to sell their coins. It's a textbook supply squeeze. And what this does is it creates what you could call a new kind of gravity for the asset. You've got this constant structural bid from institutions that acts like a floor under the price. And that is exactly why the dips are getting bought up so fast and why these pullbacks feel so much shallower than what we're used to. This table here really just lays out the paradigm shift perfectly. We've gone from a market driven by retail emotion to one driven by institutional logic. Hype cycles are being replaced with structural, consistent demand, and the whole story is shifting from Bitcoin being just another risk asset to Bitcoin being a supply-constrained store of value. So, okay, with this new paradigm, what does it actually mean for you? Well, it means you have to update your entire mental framework. Volatility doesn't just mean weakness anymore. A lot of the time, it's just a structural part of price discovery. Pullbacks aren't necessarily a sign that the thesis is broken. And maybe the most important point, the asset now trades on supply flows, not on whatever the news headline of the day is. All right, let's bring it all home for the final critical takeaway. Bitcoin has fundamentally crossed a line here. It's evolved from being a purely speculative asset into, well, something entirely new. The new framework is actually beautiful in its simplicity. You start with a structural supply problem, right? Only 21 million coins, ever. Then you add this relentless, price-agnostic demand from institutional ETFs. The inevitable result, willing sellers just start to vanish from the market. And all of this culminates in the emergence of a truly new asset class, one that trades on absolute scarcity above everything else. And this leaves us with one last really fascinating question to ponder. For its entire life, Bitcoin's value has been driven by powerful stories and narratives. But now that the story is simply one of math, of raw supply and demand, how is a market that was built on narratives going to adapt to a world that's now run by mechanics? To keep tracking these huge structural shifts and stay ahead of the curve, make sure you subscribe. We'll keep bringing you this kind of clarity on macro and crypto. And just a final reminder, this content is for educational purposes only and is not financial advice. Past performance, as always, does not guarantee future results.